Have you ever wondered why some market downturns seem to affect every single investment in your portfolio, while others only impact a few specific stocks or sectors? Understanding this difference is absolutely critical for any investor looking to build a resilient financial future. In finance, risks are broadly categorized into two types: diversifiable risk, also known as unsystematic risk, and non-diversifiable risk, which is often called systematic risk or market risk. Diversifiable risks are specific to a particular company or industry, like a product recall or a labor strike, and can be reduced through diversification. Non-diversifiable risks, however, are inherent to the entire market or economy, such as interest rate changes, inflation, or geopolitical events, and cannot be eliminated simply by holding a variety of assets. The core reason for this distinction lies in the origin and impact of these risks. Unsystematic risk arises from factors unique to a specific asset or a small group of assets. Imagine a single company facing a management scandal. This event impacts only that company's stock, not the entire market. Because these events are largely independent across different companies, combining many varied assets in a portfolio helps average out their effects. When one asset performs poorly due to a specific issue, another might not be affected, or might even be performing well, thus smoothing the overall portfolio returns. On the other hand, systematic risk stems from macroeconomic forces that broadly influence all securities in the market. These are common factors that move most stocks in the same direction at the same time, meaning they cannot be avoided by simply adding more different types of investments to your portfolio. To effectively manage these risks, investors primarily use diversification to tackle the unsystematic component. This means holding a variety of assets across different companies, industries, and even asset classes like stocks, bonds, and real estate. For example, instead of owning just one technology stock, you would own many stocks from diverse sectors such as healthcare, utilities, and consumer staples. While diversification is a powerful tool against specific company misfortunes, it offers no protection against systematic risks. For non-diversifiable risk, strategies like asset allocation, hedging with derivatives, or adjusting your overall market exposure become more relevant. Understanding your personal risk tolerance and time horizon is also key when navigating these broader market forces. An interesting nuance is that what might initially seem like an unsystematic risk to one company could become systematic if it affects a critical supply chain or an entire foundational industry, demonstrating the interconnectedness of global markets. Financial models like the Capital Asset Pricing Model, or CAPM, explicitly recognize this difference by only rewarding investors for bearing systematic risk, not unsystematic risk. This is because any rational investor can eliminate unsystematic risk for free through effective diversification, meaning there is no compensation for taking on risk that can be so easily avoided. Ultimately, recognizing the difference between diversifiable and non-diversifiable risks empowers you to construct more robust portfolios. By consciously diversifying to mitigate specific company or industry issues, you can focus your attention on managing your exposure to the broader market movements. This strategic approach allows you to optimize your portfolio's risk-return profile, aiming for more predictable long-term outcomes while accepting only those risks for which you are appropriately compensated.